This one, for many, really wasn't a shocker. Nothing happened in July, and so by the time September came along, many were saying it would probably be 50 basis points, which is exactly what it was. I think in a lot of ways the markets have priced this in. It was always a matter of when, not if, the Fed would have to pivot toward rate cuts, because it was really the choice between saving the dollar and saving the system, and the system is the bond market, and the bond market really is the Fed's real mandate, not employment and inflation, in my opinion. And so there's a number of reasons why this was simply inevitable. There's about $15.5 trillion in U.S. Treasuries that have to be rolled over in the next 3 years. And that's a lot of money in a short period of time that has to be refinanced at the government level for Uncle Sam. And, the coupon, which is the sticker price for those treasuries, had an average weight of about 2%, 2.3%. But because of the higher for longer policy under Powell and the raising rates and the price pressure that put on bonds, the actual true interest expense, the yield, was 5.3. So that's double the coupon. So that's an expensive and painful bill. The Uncle Sam literally couldn't afford Powell's policies. So this rate cut was, again, somewhat inevitable. It was really too expensive for Uncle Sam. It's also too expensive for foreign markets and everyone else. But the pivot to the rate cut and the soon-to-be pivot from QT to QE is just Powell's way of admitting, without saying it out loud, that his war on inflation was lost. We didn't hit target 2%. They may have retargeted inflation for 3%, and that might have saved a little face. But look, if things are going so well and the markets are great and labor is great and employment's great, why do we need a 50 basis point cut going into an election cycle at the end of the year? It's the classic bipolarity of what the Fed does versus what it says. Fed is just as political as any other branch of the four branches of our government now. Throwing in the towel and cutting rates when higher rates was supposed to be the fight against inflation, and throwing in the towel before they hit target inflation was just their way of saying America can't afford rising rates to fight inflation. We couldn't do it much longer, so we caved. But inflation, as I've said many times, is the end game no matter what. If they kept rates higher and didn't cut, we still would have had inflation, because that's the classic fiscal dominance argument that if you raise rates too high, then Uncle Sam's bar tab gets higher and higher. And the only way to pay for that is to print more money, which is inflationary. And if you don't raise rates and you cut rates, well, that is also inflationary. This really is damned if you do, damned if you don't. Inflation's here to stay. That doesn't mean we can't have disinflationary or even deflationary moments if the markets mean revert, even though they're effectively subsidized by the Fed. If markets mean revert, or we have and we are going to be, and I think we're already in a recession that is highly disinflationary, and raising the Fed funds rate from 0 to 5.25 or 5.25 plus in a short amount of time is inherently deflationary or disinflationary. But the end game will always be, we're in debt up to our ears. We're going to have to cover the delta between tax receipts and GDP, which isn't enough, with something that will be money mouse clicked out of nowhere, and that is inherently inflationary. So America is looking a long road of inflation, weakening dollar to cover and monetize our debts. When we took away the gold chaperone from the dollar, that meant you could create as many as you wanted, whatever politician, red or blue. In 1971, when we did that, debt to GDP was 38%, and our government debt was 426 or 425 billion. Well, you take away the gold standard and look at where we are today. Our debt to GDP is 125%, and our government debt is 35 plus trillion. That's not a coincidence that our debt levels and our money supply levels have gone exponentially to the irrational since we lost that chaperone, and since politicians were able to overpromise and underdeliver by buying votes, buying a Nobel Prize for Bernanke, and buying time by going deeper into debt, issuing more and more IOUs, kicking the can to the next generation, and ultimately to Main Street in the form of inflation, and then blaming the consequences on something else, whether it's Putin, global warming, COVID, et cetera. The real sin is in the bathroom mirror of these policymakers. And so that's where we are. Historically, in 2018, Powell, to his credit, did try to take away the punch bowl. He did try QT while he was raising rates at the same time, and that ended by 2019 in a disastrous December, Christmas, if we remember those 12% moves and 1,000 basis point moves in the markets. Huge panic. Within a few months of that, we had the COVID crisis and unlimited QE. It buys time. To Luke Groman's point, you can subsidize through QE or through rate cuts like this, and it can last for years, or it can end tomorrow morning, because there's so many needles pointing at this debt balloon and this extend and pretend policy. You can buy dips, you can save markets, by providing immense liquidity or making the cost of debt cheaper, by playing with rates or playing with the supply. When you have the power to affect the price and the supply of money, it can have temporary effects, to even Ernest Hemingway's point, that can buy temporary prosperity. The problem is it's getting too many martinis at the party, though. They can make you happier and happier hour after hour after hour into the party. But at some point, those martinis, instead of becoming sources of happy buzz, become a source of and hangover and sickness. And I don't think anyone can predict when it becomes too much, when QE and rate cuts are no longer stimulative to the markets. Technically, you can always sustain the markets, and you can always sustain the bond markets and keep yields under control with artificial liquidity, but you will always do so at the expense of the currency. And that's what von Mises warned. That's what David Hume warned. That's what anyone who understands credit markets and yields and currencies knows, that there's no such thing as a free ride. Politicians have tried to sell us a free ride since Bretton Woods was repealed in 71. But the truth is, yes, technically, historically, you can buy time for the markets. You can buy time for bond yields. You can buy time for extend and pretend. But you cannot do that without suffering some consequence. And the consequence that we are suffering, and we will continue to suffer, is the debasement of the money in our wallets, the money in our portfolios, the way we measure our wealth. In just the last 4 years, because inflation is a rate of change, not a rate of price change, we've lost over 25%, 24% of the purchasing power of our dollar in just 4 years. So when you add on that invisible tax of inflation with the higher interest rates that many Americans pay in credit cards and car loans or whatever debts they have, and then actual income taxes, again, it's not sensational. The middle class, the upper class, but the middle class feels it the most. They're basically running uphill in roller skates because their dollar is losing purchasing power because we have debased it. We have created too much of it in the broad money supply, and not just through Federal Reserve mechanizations. Many people said, I would have rather had a recession than inflation. I would have rather had other things more honestly told to me than the destruction of my currency, because that's death by a few cuts, not just 1,000. It's a slow frog boil. And regardless of the CPI scale, whatever that is, which is everyone knows is fiction, we all feel the loss of our purchasing power. We all feel the pain of inflation. And so, yes, you can save the system historically and get quantitative empirical data that shows the markets are here, the yields are coming down, this or that is doing better. But if you measure it against the purchasing power of the dollar in your wallet, you're losing. And that's subtle, and that takes a little bit of nuance to understand. I think more and more Americans and citizens of the world are starting to understand that. Certainly Eastern central banks understand that. Certainly the BRICS understand that. The question is, when does that become obvious to everyone? And you really have to watch what your dollar is doing, not what a central banker is saying. And that may sound cynical, but I think we're past the point of being naive now. Inflation, especially when it's this pernicious and this misreported and this dishonest and this devious and this ultimately inevitable, is theft. It's theft. If you lose 20% of your purchasing power in a matter of a few years, that's palpable. And if your wages or Social Security checks or annuities in nominal terms are the same, but in real terms are losing, you are literally slipping backwards, slowly at first, then as Hemingway described poverty, all at once. And again, for the middle class, which has not enjoyed the benefit of the inflation and risk assets, because the top 10% has enjoyed the vast majority of the S&P rise over the last many years, the middle class will feel it the most, and that explains why the middle class is far more political and far more polarized now than any time that I can remember as an American, whether I'm overseas or visiting. And that's true everywhere where inflation becomes a problem. The truth is, inflation, even for politicians, is embarrassing, and they understand that, and that creates a lot of frustration. But ultimately, politicians don't want to talk about real inflation, so they misreport it by at least 50%. And they also talk about other things. They distract through bread and circus or through divisive policies or divisive distractions. Again, we've talked about this in the past. Transgender bathrooms are nearly as important as not being able to make your mortgage payment or to stay in your condo because of HOH fees or whatever. So these things are going to become more and more powerful. The question is, can it be fixed? Inflation cannot be fixed in one term or through one political fiat, because we simply have no other way to purchase our own IOUs other than to debase the money to pay for that. And that IOU, that U.S. Treasury, and that debt is key to our survival. They will misreport inflation, but the sad reality is, unless we cut spending, unless we fix our balance sheet or reduce our balance sheet as a government like you would as a family or in a company, unless we do that, we're going to have to consistently debase money to pay for our own survival as a nation. Well, that always is at the expense of the citizen. The politicians will somehow survive. The citizens won't. So what do? Again, they'll misreport inflation, or even worse, to Hemingway's point, they'll distract us in wars, in which case those are inherently inflationary as a society. And in war, capital controls, yield controls, rationing becomes patriotic, and you can blame it on an adversary rather than your own politicians. I hope that isn't what happens. The only other solution to inflation besides war would again be the cutting of spending, which is political suicide. You can't cut entitlements, and you probably can't cut military by 40 to 50%, which is what we need to do. Or you can't let banks fail and not bail them out, which is what we need to do. So the kind of tough requirements necessary to avoid inflation are politically untenable at this point. And so that's why I'm not optimistic in any easy solution. Whoever's in the White House next, I almost have sympathy for. As I've joked before, it's like becoming the captain of the Titanic after the iceberg. It's going to certainly take more than 4 years, and it's going to take a population that's willing to suffer austerity for a greater good. They'll only do that if they trust the greater good, if they agree to the greater good, and if a leader will tell them that austerity is coming. The problem is you can't get elected by promising austerity. Whether you're talking about cutting taxes or whether you're talking about price controls, left or right, red or blue, both of those are going to be highly inflationary anyway, and they're not going to solve the problem. So I think we're stuck in a corner now. I think, sadly, I don't have a good solution for the inflation, and I don't have a good solution for the debasement of our currency, which is historically, without exception, what always happens when a nation gets this far over its skis in debt. The dollar may be king in liquidity, but as a reserve asset, as a store of value, as a savings asset, the dollar is no longer king. Gold is king. That is not the bias of a gold bug, whether I'm in Switzerland or in the U.S., whether you're trading from London or you're in the New York or COMEX or the LBMA. The BIS is telling us, and the central banks in the East, which are buying gold at record levels and dumping U.S. treasuries at record levels, are telling us that they don't trust the U.S. treasury as much as they do gold as a savings asset, as a reserve asset. And again, those who thought that was a sensational comment about de-dollarization and the rise of the BRICS and the rise of trade settlements outside the dollar, said it still can't replace the king dollar. I've never said it had to replace the dollar. The dollar's not going to be replaced. The yuan or the ruble or the rupee or the real are not going to be the next world reserve currency. What it does mean, though, is the dollar won't be replaced. It's being repriced. And we see that consistently now. The fact that the COMEX is no longer having open positions, but they're taking actual delivery. The fact that there is less and less, segregated, allocated gold and silver for the COMEX banks or the LBMA banks to manipulate the gold price is not a coincidence, because nations want their gold at home. They don't want it on these exchanges. They don't trust these exchanges. That gives those exchanges less power to manipulate the gold price. The repatriation of gold in 30 countries in the last year and a half is not a coincidence. The oil trade is not a coincidence. That more and more trades outside of the U.S. petrodollar are taking place every day, 20% less than they were the year before. These were unthinkable things. Even the Shanghai exchange is growing. You can't have a moving day average on the Shanghai exchange that is different than the other exchanges, so you're going to have to price gold more fairly. Even the IMF, of which I'm no fan, and central bank digital currency, of which I'm no fan, out here in Europe. Well, even their central bank digital currency, to have credibility, has some reconciliation with gold. They've said that. So all of these signs, which are way beyond just my conviction / bias, or Andy Schekman's, or Ronnie Sturfula's, or Luke Roman's, or anyone else's. And by the way, it's not even the gold guys anymore. It's Jeremy Grantham, who's an equity superman. It's Jeff Gundlach, who understands credit markets. Gold is no longer a pet rock or a barbarous relic or the things of sensationalism. It is the reserve asset of the world. It's got a tier 1 status. It's being used in net settle oil trades. It's being used in net settle BRICS trades. It could even become a BRICS currency. It doesn't matter. It will always be a net settlement trade because it is trusted more than any other fiat currency, including the world reserve currency. These are objective facts. These are not sensational facts anymore. You don't need to put on a tinfoil hat or argue about Bitcoin versus gold or argue about the US dollar versus gold. You can do that all day long, but look what the world is doing, not what the different pundits are saying. And even the pundits would agree, even if they're pro-Bitcoin, even if they're pro-strong dollar, we all agree. I mean, I look at Larry Lepard. He's one of my favorite thinkers. We have a lot of similar opinions. Brent Johnson, we have a lot of similar opinions. Certainly Brent Johnson is very strong DXY. I don't have the same opinion, but we all share the same opinion on gold. And that is why for those, whether you're middle class or lower class, if you can afford an ounce, a half an ounce of gold, if it takes you time, it's going to be a better savings asset than your portfolio, than your IRA or your checking or savings account. I'm not insensitive to, and I respect it completely. There are many people who can't get through the month with basic costs. Where and how the heck are they going to buy an ounce of silver or gold? And I do understand that frustration. I don't have an easy answer for that. It's very flippant to say, well, anyone can afford an ounce of silver, an ounce of gold. And maybe they really can't. And as I look around the U.S. and I look around Europe, and I've been in many countries this year, wherever I go, whether it's in Germany, France, the U.S., Canada, South Africa, North Africa. I'm not saying that to brag about my itinerary. I've just been traveling. Everywhere I go, yes, I'm often meeting with very wealthy clients, but you still see the real world. You still go to the pub, the kneipe, the Uber driver, the guy who's taking your bags. And when you talk to them, not only do they say they're suffering, you can see it in their face. You can see it in their mood. You can see it, of course, in crime rates. You can see it in political discord. You can see it in public distress. So again, these are no longer sensational things. They're palpable things. And unfortunately, I wish I could say they're going to get better. I wish I could say a particular political party or leader will make it better. It's going to take far more than one person or one term to get us out of this mess. And sadly, to Hemingway's point, I think we're in that stage that's gone from temporary prosperity to permanent ruin. The only thing we haven't got to is war.